What's up, guys, and welcome back to Rougefx. Today we're going over a little bit more in depth into mitigation sequences and how they breed liquidity grabs. Liquidity grabs essentially originate from mitigation sequences as well as magnetize towards mitigation sequences to pretty much rebalance price, essentially raid those buy or sell stops, trigger them, and then perform yet another liquidity grab. Before I go ahead and get started, this is the simplest trading approach to date, 2023. I do appreciate everyone who hit that subscribe button, who likes each video, who participates in the comment section below. I do appreciate all the love and support. I am very grateful to be in the position I am, to be of service, of course. If you are interested, I do offer mentorship opportunities through my membership plans, as well as hourly mentorship sessions where I will spend 2 hours with you. We will go over your strengths, your weaknesses, what you need to tune up on, as well as how to balance out your lifestyle in order to very much integrate not only your lessons within Forex, but as well as, throughout your life. Without further ado, let's get started. When we talk about mitigation sequences, essentially we're generally talking about the down move before the up move, the up move before the down move. This is essentially going to establish a weak high as well as a weak low, or in turn a weak low and a weak high. When you understand the importance of these significant weak highs and lows, you understand that they are very much liquidity, and liquidity is very much rated as well as magnetized for essentially a mitigation. If you are confused, it's very much fine. Give this video a few watches. Don't always assume one watch is enough to really kind of overall understand or comprehend a subject. When I say weak high and weak low, I want to kind of help you understand by pointing out that this would be an example of a weak high. This would be an example of a weak low. We take this overall point of interest, highlight it. Now in this case, we are essentially using our experience as well as imagination to identify liquidity within the market, to identify our point of interest, or in whichever case, a significant point of interest with a decent amount of volume for price to very much liquidate. Redefining this candle, it is important to understand that we have essentially 3 different key levels that we can very much work with as far as identifying potential or significant point of interest within the, or whichever case would be, higher time frame order block or rejection block or any kind of significant block that acts as of course a point of interest. So that's pretty much understanding that within this significant point of interest or order block, price will pretty much rebalance off of the candlestick with essentially the most volume, right? So of course we could very much understand that, again, that we have 3 different Fibonacci levels. When it came to this first key level, our significant POI with the most volume would end up being an unmitigated wick or a weak low that was very much liquidated and then magnetized to where? External wrench liquidity, or in whichever case, this mitigation sequence. Looking at our equilibrium fair value, essentially the highest form of liquidity would end up being this volume or the body of this rejection block, bullish rejection block. As you can see, if I draw my or measure this point of interest with my Fibonacci level, we have a significant amount of ticks. And as far as our third Fibonacci level, it is important to understand that price rebalanced off of the left shoulder of this, in other words, QM. Just to not confuse anyone, this is essentially what I mean about rebalancing within price. Simple rebalance. Nothing too complicated. Now I know what you're wondering. How could we expect this random, right? Essentially, to a lot of viewers out there, this would be a random order block area within price that just happened to be magnetizing liquidity grabs within our overall range. Guys, it is very much important to understand that, very much going over our ideal rules again, mitigation sequences essentially breed or create liquidity grabs liquidity grabs magnetize toward mitigation sequences. These are essentially are going to be your only two rules. When you understand that, all you need to really kind of comprehend is the market structure that's going on within essentially price action. Like, yes, we can very much use this bearish or bullish rejection block as a point of interest, but when you understand that, that means that essentially this bullish rejection block that's in front of it is holding greater volume and will essentially trigger a greater reaction or steeper reach for liquidity simply by mitigating this mitigation sequence. Moving into intraday time frame to really kind of understand these rules at a pretty significant level, as well as being able to implement them, paying a bit more attention to detail, and as of course of how price is reacting towards these key levels, as well as our point of interest, and really kind of behaving within price. As you can see, before this initial point of interest was established, we had a expansion, contraction, expansion within price. Price failed to go any higher, retest. Essentially, where is price going to go? Well, if you look left, price has already pretty much made its move, right? It essentially performed a liquidity grab or a breach of previous high, or pretty much magnetizing towards a weak high, triggering buy stops and retesting to essentially stop them out. Well, when you really kind of understand what's happening, it kind of makes our rules a bit more prominent. Liquidity grabs magnetize toward mitigation sequences. Price performs a liquidity grab of a weak high, magnetizes towards mitigation sequences. This gives you an opportunity to essentially take your long. You adjust your stop based off of course, refinement rules. What's our next rule? Back to mitigation sequences. Mitigation sequences breed liquidity grabs. Well, if not essentially this equal highs, that's going to be deemed as essentially liquidity. If you gave price enough time and were very much more patient with your essentially your process, you can understand that we have a little bit more ideal form of liquidity, which would be obviously equal highs and maybe even 20 pips above that. What is our second rule? Liquidity grabs magnetize towards mitigation sequences. This is essentially telling you or letting you know that price has essentially performed a liquidity grab. There's only any other place that we can go but a mitigation sequence. You can very much take your shorts or wait for the overall pro trend to catch up to your overall trade idea. Price essentially liquidates, and I'm going to price liquidates an inducement towards the left. Our mitigation sequence is very much breached. Adjust your stop. And where we're going to target? We target our overall 3 candle formation. We also have a slanted. We also have a weak high. It is very much important to understand that a lot of the times price is not going to just fall back towards its initial mitigation sequence. Instead, price will find support, in whichever case, a rebalancing opportunity. So we have a weak high and a weak low. We take our overall point of interest or mitigation sequence and understand that, again, this point of interest can be measured just as much as it can very much all be liquidity. Our 50 or fair value can be just as significant. Price goes from a liquidity grab and magnetizes towards a mitigation sequence, taking out an initially a weak low and or inducement, fails to break a previous high, retest, in whichever case, failure swing, liquidity grab, adjust your stops. We have a weak high towards the left for essentially a partials, and then some, of course. Understanding that this was just a expansion of an overall correction, it is very easy to realize that we have just stumbled across a weak low and a weak high. We take that as our overall point of interest, or in whichever case, a mitigation sequence. So in this case, price has essentially performed a liquidity grab, establishing this as our protected high, as well as a weak low. Understanding our point of interest measured by Fibonacci levels, it is important to understand that, of course, different areas of actual volume are very much indicated depending on where you are within price action, whether that is a breaker block, QM straight down, or a rebalance or potentially rebalancing opportunity continuing towards the lows. Why is price essentially magnetizing towards these lows besides the fact that there is a trend line or liquidity here? Well, before that, we have a weak low. Very much mark that out. And under that, we have a pretty significant point of interest, which didn't necessarily touch our initial point of interest. However, it is very much important to understand that price can be simply mitigating off of an unmitigated wick. In whichever case, we get our mitigation, maybe even a Fibonacci level or key level touch, completing the next phase in the cycle. So again, liquidity grabs magnetizing towards a mitigation sequence. We have our liquidity inducement as well as our mitigation sequences. Now what's next in the cycle? Well, mitigation sequences essentially breed or create liquidity grabs. Well, what's the highest form of liquidity towards the left? In this case would be a weak low, right? Because this is essentially established as a protected high or strong high, or a high that essentially takes out liquidity. In whichever case, equal lows, or maybe session liquidity. Understand I'm not trying to confuse you guys at all. All these concepts are very much within my playlist. If you want to learn and really kind of grow to understand this way of looking at the market, do not hesitate to reach out, of course. Do not hesitate to join my membership. Very much do not hesitate to check out these videos of different concepts and pretty much ways of looking for liquidity. So again, mitigation sequences breed liquidity grabs, adjust your stops. This is very much a reach for liquidity, continuing towards the highs. Now, I really want to take away this Fibonacci key level and really kind of just help you guys understand that yes, price can very much use these key levels as essentially a point of interest, yes. But majority of the time, it's coming back for a mitigation sequence in order to carry out a liquidity grab. It's literally heads or tails. Understand, guys, that when you get so far in your trading journey, you just grow to learn that you're discarding things that you don't need. You're just discovering potholes within the system and using it to your advantage. That's essentially what trading or Forex trading is. It's a long-term investment in acquiring skills that lead to, well, obviously, opportunity within the market, opportunity to compound your wealth, opportunity to reach a higher version of yourself, of course. Now, what makes these point of interest so significant is, honestly, majority of the time, price is going to be taking out an inducement or performing a mitigation and essentially reaching for liquidity. So if you think liquidity is right here and we have equal lows towards the left, in that case, you would be correct. However, if you're stuck on deciding if this unmitigated wick is actually going to hold and you're trying to figure out why it's not holding and you're getting emotional, as well as forcing or maybe even revenge trading, it's kind of not going to work for you. This type of trading requires sniper precision, if anything. It requires keen attention to detail. And when you understand that, it's just realizing that trading is essentially, think about it like this. On your bad days, on your worst days of, actually trading, it usually comes off of or a series of actual wins. You're actually doing well and you kind of feel that euphoric feeling. However, the times you should essentially feel more passionate or more inspired the most is when you were actually down and out and you were feeling like this is never going to work and it's this and a third and so many excuses and so many things kind of going bad in your life. Not understanding that it's kind of helping you grow and shaping you as an individual, as a person, and really kind of building your character, right? And that's the thing about trading in general is it's really going to teach you about yourself, about your life, about the things that you obviously tolerate, about the things that you find intolerable, the things that you may take for granted, the things that you can get so caught up in you're doing well, or you're performing at a certain level that you've never done before, and you forget that, bro, trading is actually difficult. Yes, it can get easy, and it does get easy with time, and it does get easy as you continue, or easier as you continue. But like trading in general, it's hard. And as you keep doing it, and as you keep improving through the years, maybe you're at year 3, 4, 5, 6, 7, it gets easy because you already know what to anticipate generally. But there's going to be that one week, um, for most, I mean, at times, month or one day that you're just not performing your best, and you're emotional, and you feel some type of way, and it's this and the third. But understand that it's the universe, or essentially the process, kind of teaching you, and kind of understand that maybe you have some work to do. Maybe you need to study a little bit more. Maybe you need to apply a little bit more love into what you're doing. Not to be corny, but like, this is your lifestyle, right? When you understand that, it becomes more than just, oh, it's just like a video game that kind of just pays you to learn it. Side note, assuming you are on a healthy track towards profitability, and not just essentially pissing your trading journey away, doing just about anything and everything. There is a big difference when you truly get to the level of understanding where you just know that these are the only two things happening within the market. Guys, it's a plethora of opportunity, and really, your profits are essentially limitless. My friends, this is the power of mitigation sequences. Not only mitigation sequences, but liquidity grabs. This is the power of understanding and really kind of investing in, overall knowledge. And not just any knowledge, but essentially the correct knowledge, right? This is the difference between understanding a few patterns, or understanding a few, essentially baby pips, or generally at a baby pips level, and really kind of just understanding price action at a master level, market structure at a master level. Only then, when you really kind of just understand what's actually happening within these markets, and how essentially fear is an illusion, right? The fear of taking risks is essentially an illusion, because these risks are very much calculated. These risks are very much like, this is a proven system that very much works within the financial markets. Given the time, effort, dedication, this will very much work out. It's really inevitable. You just have to take that first step. You just have to essentially stop second guessing yourself,